Behind every neatly trimmed lawn in American suburbia is an industry hiding in plain sight. A massive, financialized powerhouse generating over $115 billion across North America each year. To most people driving past on a Saturday morning, cutting grass looks like nothing more than a harmless, low-stake side hustle. It's the classic neighborhood teenager saving up for a first car, or perhaps a hard-working independent operator grinding out an honest living. But that humble perception is actually one of the most effective disguises in modern American commerce. When you look at a manicured patch of green turf through the sharp lens of corporate finance, you stop seeing grass and start seeing mandatory real estate obligations. You see strict homeowners association covenants enforced under threat of financial penalties, and the foundation of a sweeping commercial sector larger than traditional American manufacturing fields like agricultural machinery or commercial printing. If you want to understand how this world really operates, you have to start at the bottom by taking apart its low entry barriers and looking closely at the raw unit economics. On paper, starting a lawn care business seems deceptively easy and low risk. A single truck residential setup requires surprisingly little initial capital, somewhere between $5,000 and $15,000. That buys you a used light-duty pickup truck, a basic utility trailer, a commercial zero-turn mower costing around $7,000 to $12,000, and a handful of gas-powered handheld tools like trimmers and leaf blowers. Every spring, thousands of hopeful entrepreneurs buy that basic rig and dive into the market using a fatally simplistic math equation. They figure if a single residential lawn takes 30 minutes to cut and yields $45 to $65, all they have to do is scale up to 20 or 30 lawns a day across a few crews to build real wealth. What that naive calculation completely misses are the brutal operational realities hiding beneath the surface: equipment depreciation schedules, non-billable drive time, regulatory brick walls, catastrophic liability risks, and crippling labor overhead. When you strip away the optimism, routine grass cutting alone produces razor-thin gross profit margins of just 10 to 15%. Once you pay for fuel, routine equipment maintenance, commercial auto insurance, and direct labor, the actual net cash sitting in your bank account from a standard residential lawn cut is virtually zero. So how do operators actually make money? They have to cross over into turf health and chemical applications, nitrogen, phosphorus, and potassium fertilization programs, pre-emergent weed control, targeted pesticides, fungicides, and plant growth regulators. While basic mowing barely pays the bills, chemical applications regularly command gross profit margins between 50 and 60% because the raw material inputs are relatively cheap compared to the high billing rates. But standing right between a small contractor and those lucrative margins is a steep regulatory wall. Overseen by the Environmental Protection Agency and strictly enforced by state agricultural boards, the law prevents you from simply buying commercial-grade chemicals and spraying them for money. You need a state commercial pesticide applicator license. Acquiring that credential requires technicians to log hundreds of hours of documented field training and pass grueling state examinations on environmental chemistry, aquatic toxicology, groundwater protection, and integrated pest management. The background check and administrative approval pipeline routinely takes 3 to 6 months. During those long months of waiting, young companies are legally blocked from offering high-margin treatments, forcing them to absorb fixed overhead expenses entirely on low-margin mowing revenue. Even if you clear the regulatory hurdle, the chemical side of the business introduces catastrophic operational risks that can wipe out a balance sheet in 48 hours. Running a chemical spraying program demands absolute precision in mixing ratios, weather monitoring, and application techniques. A single mistake by an under-trained technician can instantly trigger corporate liquidation. Take a well-documented real-world case involving a landscape contractor hired to apply a selective post-emergent herbicide across a 40-acre commercial corporate campus. The job was meant to eliminate basic broadleaf weeds, but the technician on site failed to double-check the tank mix calibration. On an 85-degree summer afternoon, he sprayed a concentrated non-selective, non-selectable herbicide containing glyphosate at 5 times the recommended rate. Within 2 days, 40 acres of premium commercial turf turned dead brown, along with dozens of mature, high-value ornamental trees and shrubs framing the corporate headquarters. The property management firm immediately sued for property damage, environmental remediation, and loss of commercial presentation. Excavating the contaminated topsoil, laying 40 acres of fresh sod, replacing mature trees, and paying legal fees cost over $850,000. For a mid-sized operator without a massive umbrella policy, a single afternoon like that ends in immediate corporate bankruptcy. When you examine the income statement of any commercial landscape company, the largest line item by far is labor. Direct wages, payroll taxes, health insurance, and workers' compensation consistently swallow 35 to 45% of top-line revenue. Because field workers are operating heavy machinery in extreme heat with high-speed rotary blades, injury rates are significantly higher than in standard service trades. As a result, workers' compensation insurance premiums run anywhere from 8 to 15% of total payroll, compared to less than 1% for an office job. The physical hazards in the field are intense. Commercial zero-turn mowers weigh between 1,200 and 1,500 pounds, featuring steel decks and blades spinning at speeds exceeding 18,000 feet per minute. Operating those machines on steep embankments or near retention ponds creates extreme rollover hazards. According to federal safety data from OSHA and NYSE, mower rollovers remain one of the leading causes of workplace fatalities in land care, triggering dozens of tragic accidents every year across North America. In one verified OSHA investigation, an experienced crew member was operating a 1,500-pound riding mower on a steep embankment bordering a residential HOA property. The ground was slick from overnight rain. The rear drive tires lost traction and the mower flipped backward into 5 feet of water, trapping the operator underneath the heavy frame. The financial aftermath of an accident like that is immediate and devastating. Tens of thousands of dollars in direct OSHA safety fines, emergency medical expenses, catastrophic spikes in workers' comp premiums that last for up to 5 years, and personal injury lawsuits that easily breach basic liability limits. Yet, as dangerous as equipment operations can be, the single most persistent hazard on a landscape firm's balance sheet is labor turnover. Industry data shows that annual employee turnover in commercial lawn care regularly sits between 50 and 70%. Dry tone. Out of a crew of 10 laborers hired in April at the start of the spring rush, 6 or 7 will usually quit before October. From a corporate finance perspective, labor turn is a direct tax on operating margins. Recruiting, background checks, and onboarding cost roughly $2,000 to $3,000 per replacement worker. On top of that, inexperienced workers slow down crew speed, burn more fuel, wear out equipment through improper use, and drastically increase property damage claims, like throwing rocks through client windows with mower decks. Slows down. Financial analysts estimate that continuous turnover quietly strips 5 to 8 percentage points straight out of a company's net operating margin, frequently making the difference between a thriving enterprise and total insolvency. Suspicious. Equipment operations present another quiet vector of risk through mechanical fires and transport hazards. Natural. A standard commercial landscape trailer travels down the highway loaded with hundreds of gallons of gasoline and diesel, superheated air-cooled engines, and dense lithium-ion battery banks for handheld tools, all packed side by side in a tight space. Storyteller voice. In an authenticated incident recorded in regional fleet management logs, a 2-man crew finished a grueling summer workday and loaded their commercial mowers onto an open utility trailer. Hush tone. The engine exhaust manifold on one mower was still glowing hot after hours of continuous operation. Sharp inhale. Dry grass clippings trapped around the muffler deck caught fire while cruising down the interstate. Tense. Within minutes, the blaze engulfed the entire trailer and detonated auxiliary fuel cans, completely destroying the truck, trailer, and $35,000 worth of mowing equipment on the side of the highway. Serious. The loss of capital assets was only the beginning. Disappointed. The company lost 3 full weeks of operational capacity during peak spring revenue months, while waiting on insurance claims and replacement gear. Sigh. During that idle window, over 40% of their recurring commercial clients canceled their contracts due to missed service dates, showing just how fast equipment failure can destroy long-term client equity. Confident. To survive labor volatility, high overhead, and unpredictable weather, mature commercial landscape enterprises structure their business around a loss leader revenue model. Assertively, they intentionally price routine mowing contracts near break-even or at razor-thin margins to secure exclusive multi-year physical access to the property. Emphasized, the goal of basic mowing is never to make money on the grass cut itself. It's to establish a permanent footprint on the land so they can cross-sell specialized high-margin add-ons. Corporate presentation tone. On a mature company's books, basic grass cutting accounts for 70 to 75% of top-line revenue, serving primarily to cover fixed overhead, shop leases, truck loans, and management salaries. Excited. Meanwhile, specialized services like chemical turf fertilization, weed control, irrigation overhauls, tree care, and winter snow management generate over 80% of the company's net operating income. Confident. Commercial snow removal contracts in particular routinely deliver gross operating margins between 30 and 40% thanks to massive seasonal retainers paid by commercial property owners aiming to avoid slip and fall lawsuits. Worried. However, stepping into winter snow and ice management drops contractors into one of the highest legal liability environments in the modern business landscape. Firmly. Corporate offices, retail plazas, and medical centers maintain absolute zero-tolerance policies for ice accumulation. Serious. When a pedestrian slips on black ice in a commercial parking lot, the resulting litigation targets both the property manager and the snow removal contractor. Storyteller voice. A notorious real-world case study in snow management liability involved a major Midwest retail center during a severe winter freeze. Natural. The landscape contractor had signed a contract requiring continuous salting and plowing whenever snowfall exceeded 2 inches or when freezing occurred. Uneasy. Following an overnight freezing rain event, the contractor's night shift driver ran out of rock salt and failed to apply liquid de-icer along a pedestrian walkway near the store entrance. Breath catches. A customer slipped on clear ice, suffering a severe spinal injury that caused permanent disability. Tense. The victim sued both the retail plaza and the landscape contractor. Dry tone. In court, records show that the driver's service logs were incomplete and lacked verifiable GPS timestamps proving salting times. Dramatic reveal. The jury awarded a multi-million-dollar settlement. Quietly emotional. Because the contractor's liability policy capped out at $2 million, the remaining judgment forced the business into court-ordered liquidation. Slow and deliberate. In the winter service sector, a single undocumented application during an ice storm can erase decades of accumulated business value. Underneath all field operations, the core mathematical metric driving profitability is route density. Route density measures billable contract revenue generated per geographic mile driven and per labor hour spent. To see how the math plays out, compare two competing commercial operators, both pulling in $500,000 in gross annual revenue. Operator A manages a scattered client portfolio spread across a 15-mile radius. Their crews spend an average of 3 hours per 10-hour workday sitting in traffic, driving between job sites. Operator A operates at a billable labor efficiency rate of just 70%. Those 3 hours of daily payroll, burning diesel fuel, racking up vehicle wear, and paying insurance yield zero revenue. Operator B deliberately concentrates all client contracts within a tight 2-mile radius, actively turning away accounts outside their target zone. Drive time between sites drops to less than 45 minutes per 10-hour shift, boosting Operator B's billable labor efficiency to 92%. Over the course of a fiscal year, Operator B captures roughly 400 additional billable hours with the exact same labor force, burns 30 to 40% less fuel, slows down fleet depreciation, and drops an extra $50,000 to $70,000 directly to their net bottom line. Route density converts non-billable drive time, the biggest profit killer in field services, into pure high-margin cash flow. Even with optimized route density, landscaping remains completely vulnerable to extreme weather events that can't be hedged through standard insurance policies. Unpredictable weather swings pose a direct threat to quarterly cash flow. Consider the operational nightmare caused by historic climate anomalies like severe spring rainfalls or extended summer droughts. In 2019, record-breaking spring rain patterns across the American Midwest saturated ground conditions for over 8 straight weeks. Landscape crews couldn't deploy heavy commercial mowers onto turf without tearing up the ground and causing severe rutting. While crews sat idle in shop bays, fixed costs didn't stop. Truck loan payments, equipment financing, facility rent, and salaried administrative overhead continued to drain corporate bank accounts. Conversely, during a prolonged summer drought, municipal water bans hit, grass goes dormant, and residential clients immediately freeze their weekly service. A 2-month drought can wipe out up to 30% of a contractor's annual maintenance revenue, leaving them unable to cover debt service on expensive equipment fleets. Yet, that predictable, recurring cash flow generated by route-dense maintenance contracts is precisely what attracted major private equity firms to execute aggressive roll-up strategies across the landscaping industry over the past decade. The private equity playbook relies on a financial engineering mechanism known as multiple arbitrage. The private equity firm enters a regional market by purchasing a well-established high-volume landscape enterprise known as the platform company at a valuation multiple of roughly 8 to 10 times EBITDA. Once the platform is established, the firm aggressively buys smaller independent local operators in the same metropolitan area. These smaller targets are acquired at much lower valuations, typically 3 to 5 times EBITDA, because they lack enterprise scale and centralized management systems. After acquiring these smaller players, the private equity firm executes rapid operational integration. They eliminate redundant back-office costs, letting go of duplicate administrative staff, closing extra shop leases, consolidating insurance policies, and unifying software systems. Most importantly, they merge client lists to instantly achieve extreme route density. 5 separate trucks driving past each other on the same suburban road are reduced to 2 fully optimized trucks servicing an unbroken block of properties. The true financial arbitrage occurs when the private equity firm repackages the consolidated business. By taking dozens of smaller companies bought at 4 times EBITDA and combining them into a single highly dense corporate platform generating tens of millions in predictable cash flow, the firm can resell the unified company to institutional buyers or list it on public stock exchanges at 12 to 14 times EBITDA. They capture massive profits on the valuation spread while extracting cash flow throughout the hold period. The premier real-world example of this institutional consolidation is BrightView Holdings, traded on the New York Stock Exchange under the ticker BV. Formed through the multi-billion-dollar private equity merger of 2 historic industry giants, Brickman and Valleycrest, BrightView stands as the largest commercial landscape provider in North America. According to BrightView's public SEC filings, specifically their Form 10-K disclosures, the corporation generates annual top-line revenue of roughly $2.7 to $2.8 billion. Their revenue breakdown mirrors the broader structural reality of the industry. Over $2 billion stems from recurring landscape maintenance contracts, while the remainder comes from capital-intensive development and construction projects. BrightView operates a commercial fleet exceeding 11,000 vehicles and employs tens of thousands of field workers across corporate parks, sports venues, and commercial developments. When you look at BrightView's income statement under standard GAAP accounting, their net profit margins often appear remarkably low, hovering in the low single digits or dipping into net losses. This happens because of heavy interest payments on corporate debt, aggressive fleet depreciation schedules, and non-cash amortization expenses from their ongoing acquisition strategy. However, institutional investors and Wall Street evaluate the business primarily on adjusted EBITDA and free cash flow conversion. BrightView consistently generates an adjusted EBITDA margin of 10 to 11%, delivering approximately $300 million in annual operating cash flow. That massive, predictable cash flow provides the liquidity required to service debt, fund strategic acquisitions, maintain vehicle fleets, and provide financial stability through economic downturns. Looking closer at the microeconomics of commercial fleet operations reveals how asset management directly dictates profit margins. Commercial landscape equipment represents a fast depreciating asset class. A commercial zero-turn mower costing $12,000 has a functional lifespan of roughly 1,500 to 2,000 hours before maintenance costs spike exponentially. Financial models show that running machinery past its optimal depreciation window causes repair costs per hour to exceed replacement financing costs. Large consolidated players solve this by negotiating direct fleet purchasing contracts with manufacturers like Toro, John Deere, and Kubota, securing volume discounts of 20 to 30% below retail pricing. Small independent operators paying full retail price and financing at higher interest rates face a structural cost disadvantage before their mowers even hit the field. Vehicle fleet management carries the same dynamic. A standard 2-ton commercial service truck pulling a heavy utility trailer averages 6 to 8 miles per gallon in stop-and-go suburban driving. When fuel prices spike, unhedged small operators take an immediate hit to their margins. Large institutional platforms hedge fuel price risk through forward purchasing contracts and automatically trigger fuel surcharges on multi-year commercial agreements when fuel indices pass set price thresholds. The macro wins supporting the industry are further reinforced by legal and institutional structures across North America. Homeowners associations govern over 80% of newly built single-family housing developments in the United States. HOA covenants enforce strict turf aesthetic standards, including maximum grass heights, weed tolerances, and seasonal cleanup deadlines. Homeowners who fail to comply face escalating fines and property liens. This legal structure transforms residential lawn care from a discretionary lifestyle choice to a mandatory recurring utility expense. In commercial real estate, institutional owners, REITs, and corporate park managers view professional landscape maintenance as a non-negotiable risk management expense. Overgrown turf, unpruned trees, or icy walkways lead directly to slip and fall lawsuits, municipal code violations, and tenant lease defaults. Professional landscaping functions as an insurance policy paid to protect property valuations and mitigate legal exposure. Because of this, the revenue flowing through the commercial landscape sector displays strong recession-resilient qualities. During economic downturns, corporate clients might delay major capital projects, like building additions or renovations, but they hold on to core maintenance contracts to protect asset value and avoid fines. This defensive profile is exactly why private equity capital continues to flow heavily into the space. Ultimately, a deep financial analysis of the commercial lawn care industry shows that top-line revenue growth without operational efficiency is a recipe for financial exhaustion. Success in this business is rarely about how clean the grass looks. Real enterprise value is built behind the scenes, through tight labor cost control, acquiring specialized chemical licenses, maximizing route density, mitigating catastrophic legal risks, managing equipment depreciation curves, and leveraging financial engineering to turn basic manual labor into institutional cash flow.